right, welcome back to another video. So in today's video, we'll be looking at our solvency ratios. And what our solvency ratios look at is that they measure a company's ability to sustain their operations indefinitely by comparing the debt levels with equity, assets, and earnings. So the first ratio we're going to look at under this category is our debt ratio. And the formula for our debt ratio, it's total debt or liabilities divided by our total assets, and we're going to multiply this by 100. So our debt ratio is going to show us the percentage of assets that are financed by debt. So once again, we have 2 years from our statement of financial position for Think Numbers, where we are given the financials for 2023 and for 2024. So we want to start off with 2023, and we're going to look for our total debt or our total liabilities, as we said, which is in the middle part here and the last part of my statement of financial position, where we can see that our long-term liability or our long-term loan in 2023 had a value of 40,000, where our trade payables, our current liabilities, were then to the value of 20,000. So our total debt in 2023 then amounts to 60,000, where we're going to divide this by our total assets. Total assets meaning both non-current and current assets. So as you can see from our financial statements, our total assets amounted to 210,000 rands in the year 2023. Multiply this by 100%, then we would have seen that in 2023, we had a debt ratio of 28.57%. Moving on over to 2024, we'll do the same thing, where for 2024, our total debt amounted to 90,000, where it's the 60,000 rands plus the 30,000, divided by the total assets of 280,000. Multiply this by 100%. And then we would see that in 2024, our debt ratio increased to 32.14%, which this could probably be attributed to the fact that our long-term loan and our trade payables had increased in the 2024 year. All right, so that's number one under solvency ratios. So now we're going to move on to the next ratio, ratio number 2, which is then going to be our debt equity ratio. Also another very popular one. So please make sure you are comfortable with this one. Let's fix there. So ratio number 2, we're looking at our debt equity ratio. And the formula for our debt equity ratio, once again, it will look at our total debt, but now we're going to divide this by our total equity. And it's a ratio, we're going to multiply it with 100%. So what the debt equity ratio measures is that it measures the proportion of debt financing relative to equity. So in 2023, if we could look at our total debt as we had previously calculated, in 2023, we had total debt amounting up to 60,000. And now our total equity for 2023, which we'll find in our statement of financial position, where you will add your share capital and your equity to give you total equity of 150,000. Multiply this by 100%, then you'll find that in 2023 we had a debt equity ratio of 40%. All right, then we move to 2024, where we already know that total debt was calculated at 90,000 divided by my equity, which in 2024 was the 100,000 plus the 70,000. so 170,000. Multiply this by 100%, then you will see that in 2024, our debt equity ratio was 52.94%. As you can see, we had an increase from the year 2023, and usually you would prefer a lower percentage because then it is a lower risk. Okay. All right. So now we're going to move on to the third one that we have, which is the interest cover ratio, or sometimes they can also call this one the times interest earned ratio. Times interest earned. So they can use any of the two, but the most popular one, it is the interest coverage ratio. So interest coverage ratio is number 3. And what this ratio then looks at, it looks at the number of times a firm or a company is able to pay the interest on debt. And in order for us to be able to calculate this, we'll have our EBIT divided by our interest expense. And whatever number that you get from there is then recorded in times. So just a quick reminder, what is EBIT? EBIT is earnings before interest and tax. And what essentially EBIT is, it is our operating profit, which we'll then get from our statement of profit or loss. Okay. So once again, we have our year 2023, 2024. So let's look at 2023. So our earning before interest and tax in 2023, according to our statement of profit or loss, was as follows. So if I can just scroll down here, in 2023, as you can see there highlighted in bold, operating profit was 65,000 in 2023, where in 2024 it was 90,000. Okay, so you're going to go back up just so that I don't have to go up and down again. We're going to write our operating profit for both years. In 2023, it was 65,000. In 2024, it was then 90,000. And we're going to divide this by our interest expense. Once again, where do we find expenses? We find it in the statement of profit or loss. So let's see, when we scroll down, then we'll see that in 2024, we had our interest expense or our finance costs at 5,000. And in 2023, it was at 3,000. All right. Now, just a quick disclaimer, because sometimes students get confused between finance cost and the income tax expense. Now, the income tax expense is the expense or is the tax that gets charged to companies, right? And the last recorded one was at 28%, or for think numbers, it's at 28%. So this is the tax that they have to pay to the revenue services. So to the taxman, they're paying 28% of the profit that they have made. Finance costs, on the other hand, it is the interest that they have to pay on the debt that the company has taken out. So for this specific one, it is the interest coverage ratio. We are looking at the interest that they have to pay on their debt, which in 2024 was 5,000, and in 2023 it was then the 3,000. So if we go back up, in 2023 we had 3,000, in 2024 5,000. So in 2023 you should get that it was 21.67, which you can then round it off to 22 times, just so that we have a nice rounded number. And in 2024, you would have then gotten there that it was 18 times. Meaning, we can use our operating profit to pay for our interest expense 18 times in 2024 22 times in 2023. And generally, for a ratio like this, 3 to 5 times or more is preferred. And as you can see, think numbers is well over that range, meaning we are able to pay off our interest multiple times from our operating bit. Okay, and the next ratio, also under our solvency ratios, it's going to be the last one we do in this section. It is our equity ratio. Okay, so number 4, we have there, it is our equity ratio. And the formula for our equity ratio is that we're going to look at total equity, and we're going to divide this by my total assets. Now, what does this equity ratio look at? So it indicates how much a company's assets are financed by equity. And once again, we'll multiply this by 100%. So we'll have 2023, we'll have 2024. Total equity for 2023, as we had previously calculated, it amounted up to 150,000. Divided by the total assets, as highlighted in my statement of financial position, 210,000. Multiply this by 100, then you would have found that the equity ratio in 2023 is 71.43%. Okay, then we go off to 2024, where we calculated equity in 2024 to amount to 170,000, where total assets was 280,000. Multiply this by 100%, then you would have seen that in 2024, our equity ratio decreased to 60.71%. All right, and usually for this ratio, you want a ratio that's greater than 50% because this is considered strong and it is the most preferred. All right, so that is all on our solvency ratios today. I hope I've made it a little bit clear, and I'll see you in our next video.